our speakers to kindly come and join us. Mr. Abdul, Kader, Suriya to kindly come join us on stage. He's the Chief Investment Officer. Mr. Abdul has close to 2 decades of rich work experience in various facets of real estate and latest investments. When talk about strategic advisory or investment banking, he's one of the most famous names all across. He started his career with Morgan Stanley and focusing on decade. He's now with us. Of course, also going to be sharing up with some of the equity funds as well as domestic structured debit funds experience. With this, I also request Mr. Ajitesh Korupolu, founder and CEO ASBL, to kindly come and join us on stage. What? A big round of applause, everyone. Mr. Ajitesh is a torchbearer of the organization's vision, values and strategy, but also he tries to drive continuous innovation and creation in the organization across system, operation and people. He has overall 10 plus years of experience, and today we are going to have a glance of it. With this, I now request Mr. Anand Lakhotia to kindly come and join us on stage. Mr. Lakhotia joined Motilal Oswal Real Estate in 2014. He's the managing director and co-head at Motilal Oswal, and it's responsible for pan-India investment, managing exits and fundraising deals, sales and investing, monitoring, managing exits and fundraising as well. Well, apart from that, at Central Capital Limited, Mr. Lakhotia worked as an associate in the investment banking firm, and of course, he's also responsible for providing advisory services to companies on M&A, fundraising through private equity route, and providing valuation services to companies across a multitude of sectors. But apart from him, I also have a speaker next up joining us, Mr. JITENDRA Singh, Head of Construction Finance, Hero, FinCorp. Can we have Mr. JITENDRA on stage, please? Mr. JITENDRA Singh is a banker with a passion for real estate. He's currently leading to real estate developers, working with a large financial group, Hero FinCorp. He has been a banker for close to more than 2 decades, serving on key positions with renowned financial institutions such as HSBC, IFFL, and ICICI Bank. With him, I request Mr. Parvesh Sharma to kindly come and join us on stage. Country Head India, Tishman, Speyer Private Limited, a seasoned real estate professional with more than 29 years of experience in all aspects of real estate value chain, including land equity and of course at the same time project development, property management and leasing. Mr. Sharma is currently responsible for developing and driving the business growth strategy in India. Mr. Sharma have overall responsibility of all across in India for working towards building a track record for world-class developments in India through investment in business parks and a lot more. And now with this, ladies and gentlemen, let's get ready to move on to our last and final panel discussion of this evening. A big round of applause for all the panelists, speakers and our moderator. On that note, the floor is absolutely all yours, gentlemen. Leave it to you.
From the lending capacity or in the development capacity. So welcome you all. Thank you so much for coming. As you know, the current topic for the session is about real estate investment trends, and considering how the market is behaving, we are looking at a very different market of what the way the market was looking 5 years back versus today. Of course, Hyderabad was a very different market cycle, and we have been seeing a very good recovery or growth trend in the last 5-6 years. But in the last 2 years, we've also seen a lot of other metro cities and most of the part of the country a very significant growth trend across residential, commercial, and all asset classes. Now, talking about investment trends, if we see overall capital flow, especially the institutional capital flow last year in India was almost to the tune of about $4.5 billion. Number is significant, but it is still much less than what we saw the peak of 2019, which was about $6.5 billion. So we believe that there's far more capital which will get come to India in the next few years. This dip what we have seen last year is largely because the commercial, the institutional, large institutional investors globally, are very cautious in terms of looking at investments in the country today because of the global economic, disorder or, a lot of challenges at the global level. So we believe that there's a lot of capital which is flowing in, waiting from, global markets to come to India. But surprisingly, what has happened is the Indian domestic capital has really picked up over the last, especially last few years. In fact, if you see the overall share on the institutional lending side, capital flow side, the share of global institutions have come down from 80% back in 2022 to 65% just in 1 year. And we are also seeing a lot more HNI interest and family office interest coming into the domestic capital. So keeping this trends, I would like to possibly first open the floor for all my panelists and possibly start with the developer's perspective, because you are the one who are always looking for a capital for starting this thing. So my first question goes to Ajitesh. You've been one of those young developers who's doing exceptionally well in the market, and you have largely adopted a strategy of working with institutional developers from the very start. Right? What has been your experience, and how are you stitching up your financing side of it for all the large projects which you're executing today?
Firstly, Anuj, am I audible? Firstly, Anuj, thank you. I would like to thank Realty Plus for giving us the opportunity here. See, with respect to the banking, we are one of the early movers into taking funds from institutional players. So some of the strategies we adopted in that line was having a clean corporate structure, right? Because sometimes when banks lend, right, when we have multiple shareholders or a very complex partnership structure, then it's very difficult to lend money and even probably take a repayment from them. So one is have a very clean corporate structure. That was one of the things that we did. And second thing was we realized, see, when banks lend money, they do the Excel modeling and they do a financial model and then they lend. So what we realized is through that, probably the project commercials or the project viability gets communicated, but not the promoter intent. So that was another key thing what we looked at. How do we communicate the intent part, which is more subjective and which cannot be done through an Excel model, right? So that's why we realized that you take money from someone and pay them back ahead of time. That shows your intent, and then they come back with 2x the check. So these were some of the strategies what we adopted, and it greatly enabled us in scaling. Right? If you actually look when the market is bullish, like what Hyderabad has been for the last 5 or 7 years, there's a lot of retail participation also, like in the form of one-time sales and things like that. But the problem with this strategy is when the market flips or when it is probably going through a bearish phase, then everybody wants to run out of the room. So those are some of the disadvantages. Whereas if you have an institutional player, you're well capitalized, and then you're dealing with somebody who has very good maturity on the business cycle. So it definitely helps us seeing through the cycles of the market.
Having worked with Ajitesh, one thing which he used praising about himself, I can talk about your institution, is the transparency. I've never come across any developer who says that you take a direct access to my MIS database and see everything that you want to see on a daily basis. So that also gives a lot of confidence to a lot of institutional investors. My next question is to Anand. Anand, we have been, as your institution, Motilal Oswal, have been one of the most active institutional partners for a lot of developers, especially at the land stage funding. I think we have seen multiple transactions which you have done in Hyderabad market. Now, what kind of debt structures you guys are looking at to make it a win-win for the developers in the current market scenario?
Anuj, thank you, Reality Plus. Thanks, Anuj, for inviting us. See, we have been doing debt structures. However, we realized very early that this is a cyclical business. Cash flows are lumpy, and then you will see phases where, let us say, there are rains, there are floods, or there are some strikes, etc. And cash flow tends to become, the developer will not have, there are cases where developers don't get regular cash flows. So that is why in all our transactions, we structure the transaction based on project cash flows, we give sufficient, because we are coming at 9 stage, pre-approval stage, we give sufficient time, for developer to start repaying. In terms of, we give 9 to 12 months of moratorium to the developer, so that we don't want the corporate cash flows to suffer, or corporate getting into stress for our repayment. So we have been always very flexible in designing the structure, and while we also break up our returns into 2 parts, where part is serviced every quarter, post moratorium, balance is serviced towards the end of the project. So our objective has been very clear. Despite being a debt lender in most of our projects, the structure is more equity, where it is linked to project cash flows, where it is linked to what is the expectation in the market, how the sales will be, how then the approvals will be in place, etc. Which ensures that developer also is not, trying to take out money from other projects, or getting money, because for most of the developers all projects are levered. So it is very difficult for him to withdraw money from one project and pay off the other lender. So we have always been flexible. We continue to do that way, despite market being last couple of years has been the best times for real estate, at least in my career of last 14-15 years. We continue to do structuring transactions in similar manner, where we will give you flexibility, we will break down our returns, so that even if there are cycles where market doesn't perform, the project should be self-sufficient to repay our money.
Great. And that's been very helpful for a lot of developers we've seen. My next question is to Kader. So Kader is part of the Swami Fund, as most of you will be knowing, but we should give a lot of credit to them as an organization to bring out real estate as a sector out of from all the distress what it was a few years back, because government set it up as a fund, and these guys have invested in a lot of more than 100 projects, I guess now, in India, and all of them were in distress. So my question to you would be like, having played such an interesting revival story for a lot of these projects, what is that Swami doing? What approach the fund took, to bring these projects out, and how is it different than the other funds?
Thank you, Anuj. And thank you, Realty Plus. A very good evening to all of you. I think well said. The times were a bit different when we started 4 years back, our journey back in 2019, late 2019, when the government of India actually realized that the sector was seeing a visible stress, with more than 5 lakh units in different projects being either stalled or stressed. And that's why, with a very noble intent, this fund was formulated. Now, at Swami Fund, our approach is not only about investing, it's about transforming distress into an opportunity. And let me explain how. So, when the fund was set up, the objective was very clear that we have to bail out certain stalled and stressed projects, but that was not the only criteria. The criteria was also to actually recover money that goes into the project with a nominal 12% IRR, which may not be completely priced in with the risk that we carry, but since it was a government-sponsored scheme, it had to carry that concessional rate of return as well. Now, not only that, the mandate was massive, as in the fund had to be city agnostic, which means that I need not focus on only 7-8 cities, which most other funds do, but actually had to be pan-India. So today we operate in more than 21 cities pan-India across 110 sites, which are operating in various cities pan-India. It had to be developer agnostic, which means that we have to find developers who have not delivered anything, for whom the project may be the first project in their portfolio, and it had to be size agnostic, which means that we do deals starting from 8-10 crores and go all the way up to 400 crores. Now, this massive mandate had to have some approach which was very different from the ones prevailing in the market. So we sat down, we discussed, and we had, formulated a strategy which would be very unique. So what we did is, there are 3 distinct features to our approach, basically. The first is the combination of social impact versus commercial acumen. So while I have a keen eye on social impact and the approach is home buyer centric, but since it's not a grant, it had to come back with the nominal returns that the fund gives. The approach has to also be a little commercial in nature. So the combination of both of these is something that we keep grappling with every proposal that we analyze. So today we have we are sitting on a proposal of 1,1500 plus pan India, but out of those only 110 could go through. So that was the first distinctive feature of our approach. The second is, when you're doing something like this, the due diligence, the screening and the asset management has to be really, really tight. So the underwritings have to be robust enough to be resilient in all times, and the cost structures that have gone haywire in particularly last 2-3 years is a testimony of that. So when we underwrite residential projects at Swami Fund, we don't underwrite them as residential. We underwrite actually them as commercial, which means that we don't rely on any inflows or any internal approvals during the construction phase. We give a line to the developer such that come what may, the project goes through. Because only when the project goes through, project gets completed, home buyers get their deliveries back, will the fund make its principal.
So we finance them for the entire construction cost.
We try to, depending on the phase of each project, we do phasing, and we ensure that at least during the construction phase, the dependency on the receivables, both sold and unsold, is minimal. So a line is extended to the developer. Obviously, the draw could be a little less depending on the construction stage and the cash flows generated in the interim. And third and most important part rather is the asset management. So once it's easier to invest, it's very difficult to actually asset manage and exit a project. So we have a very, very involved and tight asset monitoring approach at Swami. We have our eyes and ears on the ground in the form of our project monitoring consultants who actually visit the site. They are there 5 days a week, 7-8 hours a day each, and every payment is directly made to the third-party vendors and consultants. So this kind of model, which I'm happy that the industry is fast. It's becoming a new norm in this industry for the last 3-4 years, coupled with the fact that the governance is also improving. But that's something that we do differently as compared to other funds. The size and scale here is really massive.
No, I mean, it's very commendable the way the recovery of some of these projects has happened across different parts of the country. Unfortunately, we never got a chance to work with them. I remember he coming to my office about a year back, and I said I have nothing to offer because not a single developer in Hyderabad needs any distress money. So everybody's full of pre-sale and cash flows. So, but I'm sure, the way the market looks like, I hope, some transaction will be in Hyderabad as well. My next question is to my very dear friend Parvesh. So Parvesh, you represent the international developer community. You represent one of the most, renowned and very large global developer in India, who's been present from day one. And you have seen cycles. You are the man behind who has built Wave Rock. You have seen Hyderabad very closely. Now, what we have seen, especially the large developers like you, in India also, now for financing strategies, they have started setting up their own AIFs, right? And I know that for sure that you also have partnered with Axis and setting up your own fund for commercial real estate. Now, how that strategy is panning out? Like, do you see that that is a model which most developers will adopt going forward?
So, Anuj, that comes from the global experience that we have realized it working in the various geography, that the best way to have the funding for this project is to have the domestic money there. The foreign money always looks good, but that comes with its own challenges, whether it is the currency risk, whether it is what is happening in their own countries, how do they perceive it. Then also this same money has to be deployed in various geographies, so you are competing with different geographies when you are trying to get the money from some of these large fund or the fund of funds. That's where you are getting the money. So we realized that the best way is to get the money domestically through a route which we have done it in China very successfully. We have raised a couple of $1 billion which has been deployed successfully in various projects. In India, we partnered with Axis AMC, and that's where we started with this AIA fund. We are probably the first one to get into this route, especially a development fund. There have been funds which are more on the debt side, providing that kind of opportunities. But educating the retail customer for this kind of product was not easy. It was a challenging assignment. When we are collecting 1 crore rupees check for the AF, the investor base, they typically understand the yield products and they are looking at something which is more liquid in nature. But this product is having a lifespan of 7 years, so your money is locked in for a period of time. And it is a lump back-ended return. It is not that during the period you are getting anything. So selling this product by Axis AMC through their internal and external channel partners, it requires a lot of efforts for us also to be part of those discussions when they are sitting with the investors, explaining them how this product actually works, telling them that there is a 20+% IRR which can be generated on the real estate. It is not easy to explain to most of these investors who are the retail investors, but we feel that is the best way to raise their money domestically, and it also addresses a lot of that currency risk and other things, factors. This is the first fund, but we know that there are a lot of other developers who are looking to go down this path, raising the money and deploying it. So we are right now in the deployment phase. So we have raised substantial capital to put up into the projects. These funds are well regulated funds by the SEBI, so the investor doesn't have to worry about from the regulation point of view. There is a diversification norm, there is how the fund is to be managed, how the fees is to be paid. All of that is, I think the SEBI is doing a great job. So maybe the next funds or the next developers who are going down this path, the things will become much easier for them when they go out in the market.
Sure. Thank you. Jitendra, I'll come to you. So as your enterprise, Hero has been one of the very active construction financing partner for a lot of, especially the mid-sized to large developers. Now, and we know for the fact that, the RBI has put restrictions in terms of a lot of land stage funding, and it is only limited to AIFs and all. Now, how are NBFCs like you are supporting the, developer partners in terms of the structures, what we do, like cash outs, or, for helping them to do cash outs or financing them for the next set of equity for the next project? Can you elaborate on some of those structures what you're following?
Sure. Thanks, Anuj. Thanks to the realty team as well. Being the last panel is quite tough because most people are looking at when we can exit. But it's good and very encouraging to see so many people still sitting patiently and willing to hear us out. So, coming to Anuj's question, I would like to say that yes, people are looking at land purchase primarily these days because there's a very limited concept called construction funding now. Because people are looking at growth capital, or if I say opportunity funding, so to say. But yes, RBI has put its clamps on NBFCs, and we cannot lend at least to that project from where we will expect our receivables to come from. So having said that, we still look at avenues to fund. We look at, there are ways to do it. We do inventory funding. So it can be in the form of a general corporate purpose, it can be in the form of a working capital. Rather, these two concepts are slightly less costly also compared to the gentleman on the left side. so that's a little less costly affair. We've had a little discussion on this yesterday as well, because by the front page news in Business Standard, where two veterans of our industry, Mr. Deepak Parekh and Mr. Kader from SBI also noted that banks should be allowed to lend for land funding, because everywhere in the world it is happening, and so be it here. So, considering that it has come from very two heavyweights of the industry, we feel that maybe the floodgates can open. If that happens, I think we will also get more direct opportunity instead of going via transaction of inventory funding or this through working capital and so on, so in the form of equity takeout. But having said that, yes, equity takeout cannot be given to each and every one. We have to see how much the committed receivables are there, the collections or sales have been done, and at least 30% of construction should also have been done for that particular project which we have funded. So in that case, we can do the financial closure.
If the financial closure is secured,
Yes.
we can look at some.
We can look at that. But yes, for every builder who comes forth very long, we don't want to do that and fall into a debt trap, because this is what happened in certain parts of the country. Probably where I come from, in the north side, where people fell into a trap. They started borrowing, then they lent further, But of course, it had its own rules and regulations of 10-year period also. So those lacunas have now been removed, and we have RERA in place. With RERA, we are more cautious and there's a lot of financial discipline being maintained. So that takes care.
Sure.
I suppose that takes care.
Yeah.
Thanks, Anand.
Thank you so much. Ajitesh, I'll come back to you. Over the last few years, Hyderabad has seen a fantastic cycle, and we all have seen there is a model adopted by a lot of developers in terms of pre-sale or upfront payment sale, and that has been done at scale, right? Now, as a developer, what is your view on that approach? Do you think is it sustainable for developers to follow that, especially in the downward market?
See, Anuj, with respect to a downward market, no, it's not at all sustainable. In a bullish market, I would say there's a 70-75% chances that it will see the light. But see, the biggest problem with the pre-sale type of structuring is that the exit plan. Right? When you borrow money from a bank, let's say you borrow a couple of 100 crores from a bank, you're dealing with one entity and you're working on one exit plan. Right? Let's say somebody raises the same equivalent money on a one-time payment scheme, then you're working with 200 different investors and 200 different exit plans. And it's these uncertain exit plan which ends up screwing up a project. Right? You never know when somebody would want to exit, and the logic is simple. Whatever the developer would be selling, it will be minus 500. So essentially, there will be one counter and two sales. Either people might not just buy there, or they are buying at the lower price. So this leads to the problem of developer not being able to do a regular construction linked sale, and hence the construction cycle gets slowed down. But having said that, why it did happen, right? For whatever reasons it had happened. One, there was a bullish phase, so everybody wanted to chip in. The basic narrative was, okay, when you take money for a land stage funding, it's approximately at 18%. So investors are like, it's the same return, why don't you give it to me? Right? So that's how it all started. And then when you're working with a bank, there's a way more due diligence, right? There's a balance sheet, level plan, the capability. When you do on a one-time payment basis, there is no due diligence on one's capability, or then, balance sheet, whether, they have the financial resources and all. So these are, some of the major, negatives of it. Yeah, but in a bearish market, I think it will be kind of difficult because of the various exit plans.
Sure, thank you. I'll come next to you, Kader. We have seen one of the strategies adopted by a few global institutional investors, where they've gone and done platform deals with very large developers, for either for affordable housing platform or for other approaches. Now, we've not seen many domestic institutions doing that partnerships with prominent and good quality developers or regional developers. Do you see those kind of platform deals a possibility with some regional developers? And if so, what kind of structures do you think would be interesting?
I think good question, interesting question. Yes, you're right. More than 4 billion plus worth of platform deals have been announced last year. And I think the similar number, if I'm not wrong, got clocked in the year 2022 as well. So I think a couple of things really stand out in all this. So one is, if you see the guys who are doing platform deals, one is this tier 1 credible developers, no doubt about it. But on the other side, we're talking about foreign fund managers handling foreign pools of capital, deep-pocketed and long-term patient capital, which is chasing these kind of platforms. Yes, residential also, there are a couple of them, but these are more for asset classes which are not residential. As Parvesh touched upon, the asset classes which are more predictable in nature, which are more stable in nature, and which are more like ownership fee. So be it commercial, industrial, retail, even hospitality, that's seeing more interest on that part. Now, does it make sense for domestic institution to do this? Absolutely yes. So as fund managers, if you're okay, if you're comfortable with a particular tier 1 developer or even an emerging tier 2 developer as well, it makes sense for you to do repeat deals and play on a particular strategy, even if it's affordable housing or commercial or industrial. The challenge really is what kind of capital the domestic institution is handling. If it's an HNI or retail money, the investors like to see a more transactional approach, which is basically, let's say, 3 or 4 year kind of commitment period, just get in, get out. I'm talking about residential strategy specifically. But on the other hand, if you have tapped LP base, which are more corporate houses or even insurance, perhaps pension funds as well, which are more long-term and patient in nature, then it absolutely makes sense for even domestic fund managers. And I think we should see some interest very selectively going forward for this kind of a product. I think Ajitesh did mention about the corporate governance part, because this, if it all happens with the domestic institutional managers, it will happen only for civet developers who are right up there in the form of corporate governance, transparency systems and processes and so on.
No, very well done. Thank you so much. I'll come back to you, Parvesh, primarily because of your exposure and experience in the commercial sector. Now, globally, we've seen a lot of turbulence, with a lot of vacancy in markets, like especially US and all, and commercial office and all. And I think that has also led to, a lot of changes in the cap rate expectation in markets like India. And especially coming to Hyderabad, we've also seen the challenge of an oversupply situation which is there. Now, in that scenario, we are hardly seeing any transactions of the core assets, because there's a very clear mismatch in terms of the value expectation. Developer doesn't want to sell at that price. Now, do you think in these cases, why are we not seeing the forward purchase kind of transactions? So barring 1 or 2 developers, we have not seen many transactions in that case. What are your views on the forward purchase kind of transactions for markets like Hyderabad and otherwise also?
Yeah, so Anuj, I think the financial closure which is required in the commercial projects are very different from the residential projects, where there is a receivables which is coming during the project execution stage also. Here it is all back-ended things, and especially if it is a build-to-lease property, which we do it, the CF getting it, they also look at it, what is your exit strategy, and that is why the funding is available to the developers who has a track record of leasing the property and making an exit out of that one. I think the other way to look at is that if for a funding strategy, whether, and then I'll tell you, every funds are chasing the core assets or the value strategies. That is what most of the funds are looking at it.
True.
But where is the new development coming? There is right now 700 million square feet plus of a grade A office space available in India, out of which there is a large amount which is going towards the REIT. The rest is like the Blackstones, the Brookfields, and the GICs. They are buying those assets. But somebody has to create these assets also. So when you are creating these assets, nobody is trying to take that risk, coming at an early stage of the land stage and developing it, leasing it, and then exiting it. So that is where developers or somebody like us gets into that area, take that risk of developing that asset. But again, from an exit point of view, sometimes it becomes much easier if you are having a forward purchaser in place. And why the forward purchaser can be a good strategy going forward, it's already being executed. It's not a new strategy, but I think it's very limited right now. Maybe 1 or 2, the Singaporeans are more keen to do that one. But we have seen that 1 or 2 odd transaction has happened by some other funds also. But it's not too prevalent in the market. We have seen that right now there are few funds being raised. Edelweiss has raised it, Novama is doing it. Those strategies are somewhere midway. They are not coming at an early stage, but Nuvama is looking at when the project has reached to certain construction or certain amount of pre-leasing which has happened. So that is also when they can get into forward purchase agreements. Forward purchase agreements helps you to get that initial funding shortfalls, which the banks probably cannot get into. There are funding strategies which will help even to get you the land funding as part of that forward purchase strategy, which some of the forward purchasers do it. That part of the land they can do it a forward purchase mechanism. Rest is all the construction finance mechanism or similar structure which happens there. But the good part is by entering into this structure, your exit strategy is very clear. The cap rates are locked in today, which can have upside and downside. Means today we are probably the consensus that we are the peak of the interest rate, so it will come down. If it comes down, the cap rate will also move along with that one in a downward direction.
True.
So if you are going for a 4 years, 5 years exit strategy today and deciding the exit cap rate today, it may not be the best way to do it, but it is also a risk-free strategy. It is the risk rewards which you are looking at it. So from a risk point of view, you are very sure that when you build it, you have exit at 10% or 9.5% cap rate. Somebody is buying it out, that is. But I think that what you are losing is the upside. If tomorrow the cap rates goes below 8%, that upside you are losing.
Sure. Very valuable. Thank you so much. Jitendra, if I can come back to you, like I said earlier, you guys have been very active in the financing, the construction side of it. We are seeing a lot of high-rise development in Hyderabad. And one of the trends which we have been noticing is that a lot of construction finance lenders are shying away from financing, 45, 50 floor structures. Now, what as an institutional lender, what challenges are you seeing there? And if institutions are not supporting that, what are the options with the developer to finance those kind of things?
Is it specific to Hyderabad?
Yeah, this one is specific to Hyderabad.
Okay.
Yeah.
So in Hyderabad market per se, earlier there were not too many tall buildings as such. So I guess that was an apprehension. Nowadays we've had few buildings which have come up and people have bought houses there. So I think that appeases your sentiments to a large extent. The negative sentiment gets removed. So the cobweb which was there, to a large extent has been removed. Of course, as a lender, I would probably see the kind of engineers who've been deployed because the wind velocity is very high at the top. So the cost of construction also goes up. So whether they have been built in and how much funding we can give. So yes, from that point of view, the higher you go, the costlier the property also gets. And of course, the foundation also has to be very strong. So we will learn money, there is no doubt on it, the higher, because people in other cities, I have seen the higher you go, the costlier it is. Be it Calcutta, be it Bombay, even Delhi now people are talking about, in Newton Delhi also people are talking about coming up with a little taller buildings. So yes, tall buildings are definitely pretty much in vogue. Even Noida, Gurgaon, we've seen tall buildings, so people are occupying those. And nowadays you even get systems where people can actually see how the view will look like. So salability also from that aspect is not an issue per se. So as a lender, I will not see it as a hindrance if it comes to a high-rise per se.
Now we know whom to send the proposal. There is a 50-floor structure. Because I am able to get anybody else to convince them to lend money from the business.
We are pretty much open.
I'll take a note of that. Okay, my next question to Anand. Anand, we've seen some very interesting times for a lot of these residential market across top 10 cities. If I can see, there's a massive rebound. We are seeing residential sales which we have not seen for the last decade or so. That kind of numbers coming back, and with a lot of developers' balance sheet getting cleaned up. They are coming back into the market with, I'm sure, with new projects. You are seeing it with Mangalore, Pune, all across. Now, what kind of traction are you seeing from a land stage funding? Because earlier, not many of these markets were very aptly placed from a land stage funding. But today, do you see that change happening in a big way? Developers in other city looking at landscape.
So, Anuj, I think last couple of years, the kind of sales we have seen, and especially, if you are a renowned developer with good track record, they have seen phenomenal sales. As per our research, in-house Motilal Oswal research, inventory overhang for listed players is now close to 6 months, which essentially means that if they don't launch any new project, in the next 6 months they will be sold out. Which is resulting in all these players, going for big expansion plans. They are acquiring lands and getting a land which is clear title with minimum complexities is also very difficult. So what we are seeing is developers, and this is happening across category A, B, C, all kind of developers. What we are seeing is that they are in search of land, and once the land is identified, they are of course again in search of capital. So we are seeing massive amount of inquiries for land stage capital, and because we are one of the few players who come technically at land buying stage and really take all the risk with the developers in terms of approvals, all the process and the timelines. We are seeing a lot of inquiries, lot of proposals from developers for land acquisition. It is up to us how much we can deploy, and I think given where the market is, we as a house are very we want to work with only select developers who have proven their track record even during downturn, and we are selectively doing transactions now.
Great. Kader, one last question for you. In the current market scenario, we've seen a lot of rise in the interest rates and cost of capital and all. How do you see the trend? In the next 24 months, do you see the cost of capital coming down? Because at land stage, what Anand was saying, people are expecting returns of upwards of 18-20% IRR. Like even the construction finance rates were very high. What is your broad view on the macro level, how the rates will span out over the next 24 months?
So I think real estate operates in cycles. So typically residential real estate cycles last for about 6 to 8 years. So if you look at 2012-13 to 2020, prices were really stagnant. In some cases, in some micro markets, prices even corrected a bit. But then there was sharp increase in sale prices post 2020, 21 specifically. So we believe that this could be the midpoint of the current bull run that we are seeing, at least on the sale prices side. So the inventory overhang, as Anand touched upon, is coming at an all-time low, best year in the decade in terms of sales and inventory overhang. Now coming to the cost of capital, 17 to 18% land stage funding, I think, is there to stay for quite some time in at least the residential real estate. The key to tap this strategy is really going with your eyes and ears open, doing a very robust kind of underwriting for you to ensure that you don't get stuck at any stage in a project. So again, the key is to be agile enough in your strategy, give a solution to the developer. At land stage, I don't think in next 2 to 3 years at least, this cost of capital of 17-18% IRR is coming down. Yes, in for the years 2017 onwards, I think there was a little bit of disruption where quite a few NBFCs flooded the market. They may have mispriced the risk at times, and that led to a lot of disruptions, which was followed by consolidation in this space as well. But I think when you're going in at a land stage of pre-approval kind of a funding, 17 to 18% IRR is something that your LPs or investors would want you to chase, and that's the right kind of pricing in my view, at least for the next 2 to 3 years.
Jiten, do you have any view on the construction finance rate in terms of rates? How do they span out?
I guess after elections we will definitely see action in this space. As you mentioned initially also, we are living starved of funds. So I think markets are already getting bullish in terms of because people are probably aware of which party is going to come. So till now people were cautious and were fence sitters, so to say. So they were not deploying the money, because when you have billions of dollars coming into the country, people are generally cautious and they wait. So generally we've seen in a run-up to any elections, there is normally so to say, a little kind of quietness in the market. But on the contrary, we've seen even the stock market, which is a barometer of the economy, the markets are going up and up and up. So, even PSUs for that matter, which was always a bell sitter, has done really well. So, RBI monetary policy also, Mr. Das said, yes, inflation is probably the only enemy right now, so to say. But we will see the markets coming down on the rate front. Definitely that will happen.
Just have a quick last two questions. One to Parvesh first. Parvesh, you must be in touch with a lot of your fellow global developers. Do you see some of them looking at India, coming to India and partnering with the developers here in the near future, at least in the next 2-3 years?
See, on the developer side, there are not too many, but on the fund side, there are a lot of people who are looking to enter, and especially I would say the eastern part of the globe now, they are very active. The Japan is very, very active, and they are looking to come to India in a big way. There are already, like Sumitomo has taken up lands in BKC in Lower Parel at a huge price. And these guys generally comes in clusters, and we have been in touch with most of them, and we find that the next wave of the investors will be from Japan.
Okay, fantastic. My last question of the session goes to Ajitesh. Being a developer, I mean, how do you see the financing landscape for developers changing in the future? What kind of things developers can adopt, new approaches to be more investable, if I can say so?
See, Anuj, I think looking forward, technology is going to play a major role in bringing about transparency and efficiency in operations. So what this would do is it would disrupt two sides of the financial, the entire investing part, right? So one is once you deploy the fund, how you're going to manage it from an institution perspective. There also we see there is going to be a great disruption. And the other side is how you raise funds. That also is going to see a disruption. So from the point of view of how you do, the fund management after it is deployed, I think slowly the days of, where you lend money and then and monitor on the basis of a financial model, that is going to go away to a more transaction-led monitoring, right? So currently what happens is once the funds are deployed, then the banks collate data once a month or once a quarter, and then probably plug it into the model and see how it's going on. But going forward, this is going to go away where companies are going to directly inject their accounting data and CRM data into the bank's monitoring system. So every transaction is recorded, and pretty soon there will be some algorithms deployed, and probably those would be raising the red flags if at all there's any. So we're going to move away from a model-based monitoring to a transaction-based monitoring. That's on the management side. Whereas when it comes to the fundraise side, I think as developers gain in size and scale and trust, they will be able to probably raise fund from the goodwill they have generated from their customers, right, through various financial structuring like NCDs, and then they might be working with the banks to probably convert, make that money into proper financial tools. So it becomes a much more investable tool, if at all. See, any which ways, if you look at the one-time payment sale, it's essentially an 18% to 20% IRR bond, right, for a 4-year bond. So, and most of those people are going to celebrate those units and make their return. So we do see a scenario where instead of doing all this junket, they can just subscribe to the bond, and the bank can probably underwrite it and make it into a financial tool, and then that's how they will be getting the return. If at all somebody wants to see another problem with the typical asset-based model like the one-time payment, somebody wants to exit, it's difficult. But if you're holding on to a bond, you can forward sell it and then exit. So these two is what we are thinking would be disrupted in the way forward.
Very interesting. I think I'll stop. Any more questions? I have a friend here who has to catch his flight also. So any questions from the audience? Happy to take it.
Anuj, I would just like to add maybe, and then
Sure.
positive note. I think the next 3-4 years, like I travel various places in the country. So the next 3-4 years are definitely for real estate. So each one of us here can cash in as much as possible, except in Swami Fund. So, but yes, tier 2, 3 cities also.
So one thing I know for sure from Kader is that they are not anymore looking at only distressed projects, any project getting financed. I think it's more of a perception that they only look at distress, but they are looking at every other project also from a construction point, right?
I think that 12 to 14% it will make the entire landscape way more competitive.
Okay. I saw one hand at the back. Somebody can somebody pass the mic to?
Where inexperienced people are getting into the development space to make money, and if that's happening, what is your advice to them?
Who is this question addressed to?
To the panel in general.
All the new developers who are coming in.
See, like I mentioned earlier, we had issues, especially in the north side, where every broker or anybody became a developer because we had payment plans for 10 years and so and so. But nowadays, that has been stymied to a large extent. So, to be a developer now, you need fair amount of equity in your purse. Otherwise, you can't become, you need knowledge. People have also become far more educated after that. So, yes, it's, so that's not like a gold rush anymore.
I think he's referring more from a Hyderabad recent experience that a lot of new developers have come in, and from that point of view, to some extent, I personally agree with his view that a lot of new developers coming in, not necessarily that everybody has a complete view of the execution cycle, but yeah, that's like that happens in any industry. Well, it's nothing to do with real estate or any individual. Every industry go through this phase of growth and then consolidation, and then we'll see the new set of players coming in. So I think that's a massive.
So put it mildly, it is like the penny stocks doing very well in today's times.
Just to add to that, see, what I would say is, if one is it's always good that new players are coming. It will sort of challenge the incumbents, and there will be a churn, and the customer is set to them. But I think if somebody is a new developer, one thing they have to look out, most important, at least going forward the next couple of years, is understanding the entire cash flow model and making sure there is sufficient cash in the balance sheet to see through probably a more steady market. So I would say that's a very important thing.
One last question, if anybody, otherwise we close the panel. I think we're good. Thank you so much. Thank you everyone for patient listening, and thank you for all the panelists also. Thank you.
Thank you very much. And with this, I request our panelists and our moderators to kindly stay back with us. Then please invite Sapna Srivastava to kindly come and join us on stage. She is the editor of Reality Plus, to present a token of appreciation to all our moderator and the panelists. That was a great session, I must say. We had enough time to have the Q&A. And I hope we all made it pretty clear. If you have any confusion, any queries for any of the panelist sessions, what we have done today, we have all of them right here. So we are going to take a short break where you all can socialize or have your Q&As done for sure. But meanwhile, of course, let's appreciate the effort of all our panelists. Thank you so very much. Thank you very much, sir. Last but not the least, the person who made it so obvious to present the whole panel discussion so beautifully and gracefully. Thank you very much to our moderator. If you have any questions and answers, please go ahead for socialization. And now we are going to take a short break, and give this hall a makeover for the soon to be presented Reality Plus Excellence Awards 2024 Hyderabad. I would like to request our audience to please